Hello students, welcome to another video of Upskilling Commerce. Today we will be discussing banking sector in India. Banking system play a vital role in ensuring financial stability and supporting economic development. Banks provide a safe place for individuals and businesses to keep their money, protecting it from theft and loss. A bank acts as a financial intermediary and it functions as a bridge between savers and borrowers in the economy. It collects money from individuals and businesses who have surplus funds and are looking for a safe place to deposit them. At the same time, it lends these funds to people or organizations that need capital for consumption, investment, or business purposes. By doing this, the bank facilitates the flow of money from those who want to save to those who want to spend or invest, thus promoting economic activity. The bank earns income by charging a higher interest rate on loans than it pays on deposits. This process of financial intermediation not only supports individual financial needs but also contributes to overall economic growth and development. They also offer credit facilities, allowing people to borrow for personal needs, education, housing, or business growth. The banking system enables smooth and efficient payment transactions through methods like online transfers, UPI, and debit or credit cards. By collecting savings from the public and directing them into productive investments, banks help industries and infrastructure grow. Additionally, banks assist the central bank in implementing monetary policies to control inflation and manage the money supply. They also promote financial inclusion by extending services to rural and underprivileged areas and support government development projects by funding infrastructure and purchasing government bonds. Thus, a strong banking system is essential for a healthy and growing economy. Now let's discuss primary functions that are performed by a bank. Primary functions of a bank, like accepting deposits and lending money, are vitally important because they form the foundation of the entire banking system and have a direct impact on the economy, individuals, and businesses. Without the primary functions, a bank would not be able to support the economy, serve customers, or ensure financial stability. They are the heart of all banking operations. The first primary function is accepting different types of deposits. Accepting deposit is one of the core functions of a bank. It means banks collect money from the public and safeguard it for them. These deposits serve as the main source of funds for banks, which they use to give loans and run other operations. Different types of deposits which a bank accepts are: the first one is saving deposit. So a saving deposit is a basic banking service where individuals can park their money safely and earn interest. It's one of the most important parts of the accepting deposits function of a bank and is designed to encourage the habit of saving among the general public. A savings deposit account is meant for individuals to deposit surplus money they don't immediately need but might use in the near future. Banks pay interest typically ranging from 2.5% to 4% per annum. Saving accounts are ideal for salaried individuals, students, retirees, and small savers who want both security and liquidity. These accounts offer features such as ATM access, check facilities, mobile banking, and regular statements, with some accounts requiring a minimum balance and others being zero balance accounts. Banks offer different types of saving deposits to meet the specific financial needs of various customer groups like students, workers, women, senior citizens, NRIs, and more, while promoting the habit of saving and providing convenient access to funds. It helps the bank generate funds for lending to others, thus contributing to the economy. By promoting disciplined saving habits and financial inclusion, saving deposits play a crucial role in personal financial planning and national economic development. The next is fixed deposits. A fixed deposit is a financial product offered by banks where customers deposit a lump sum of money for a fixed period at a predetermined interest rate. It is one of the most secure and popular forms of investment for individuals seeking stable returns without market risk. The interest rates on FDs are usually higher than those on saving accounts, and they vary based on the tenure, which can range from 7 days to 10 years. During the deposit period, the money cannot be withdrawn without a penalty, making FDs ideal for long-term saving goals. At maturity, the depositor receives the principal amount along with the accrued interest. Banks benefit from fixed deposits by using the funds for lending and investments, thus supporting their income generation. Overall, fixed deposits serve as a safe, interest-earning savings tool for customers and a stable source of funds for banks. The next is current deposits. A current deposit account is a type of bank account primarily meant for businesses, firms, companies and professionals who need to carry out frequent and large financial transactions. Unlike savings account, current accounts usually do not earn interest as they are meant for liquidity rather than savings. These accounts allow unlimited deposits and withdrawals, making them ideal for daily transactions. Banks often provide features such as overdraft facilities, checkbooks, online banking, and transaction alerts with current accounts. While a higher minimum balance may be required, current deposits offer convenience, flexibility, and speed for handling large volume of payments and receipts. For banks, current accounts are a valuable source of low-cost funds as the deposited money remains ideal and can be used for lending and investment. And the last one is recurring deposits. A recurring deposit is a type of savings scheme offered by banks that allows individuals to deposit a fixed amount of money every month for a predetermined period and earn interest at a fixed rate. It is ideal for people who want to build a saving habit through regular monthly contributions rather than investing a lump sum. The tenure typically ranges from 6 months to 10 years, and the interest rate is similar to that of fixed deposits. At the end of the term, the depositor receives the total amount saved along with the accumulated interest. RDs are popular among salaried individuals and small savers due to their simplicity, low risk, and guaranteed returns. For banks, recurring deposits provide a steady inflow of funds which can be used for lending and other operations. The next primary function of a bank is granting of advances. Granting loans and advances is one of the primary functions of a bank where the bank provides funds to individuals, businesses, and governments with the expectation of repayment along with interest. This function plays a crucial role in promoting economic activity by enabling borrowers to invest in businesses, purchase assets, meet personal needs, or manage working capital. Loans are typically granted for a longer duration and repaid in installments, while advances are short-term credit facilities provided to meet urgent needs. Common forms of lending include term loans, overdrafts, cash credit, and bill discounting. Different forms of loans and advances are: the first is overdraft. The overdraft facility is a short-term credit service provided by banks that allow account holders, typically current account customers, to withdraw money beyond their available balance up to a pre-approved limit. This facility offers flexibility to businesses and individuals who may face temporary cash flow shortages, enabling them to meet urgent expenses without the need for a formal loan application each time. Interest is charged only on the amount overdrawn and for the period it remains outstanding. Overdrafts are usually secured against collateral or a fixed deposit, though unsecured overdrafts are also available to trusted customers. This facility helps maintain smooth financial operations by providing quick access to funds and supporting working capital needs. For banks, overdrafts generate interest income and strengthen customer relationships through flexible credit options. The next is cash credit. The cash credit facility is a short-term borrowing option provided by banks to businesses to meet their working capital requirements. Under this facility, banks sanction a credit limit based on the borrower's inventory, receivables, or other current assets, allowing them to withdraw funds up to that limit as needed. Unlike a fixed loan, the borrower can use and repay the amount repeatedly within the sanctioned limit during the tenure, which is typically up to 1 year and renewable. Interest is charged only on the amount utilized, not on the entire limit. Cash credit helps businesses manage day-to-day expenses such as purchasing raw materials, paying wages, and meeting other operational costs, ensuring smooth functioning without cash flow disruptions. For banks, it is a profitable lending product that supports the growth of small and medium enterprises by providing flexible and accessible finance. The next is loans. A loan facility provided by banks is a financial service where the bank lends a specific amount of money to an individual, business, or organization for a predetermined period within an agreement to repay the principal along with interest in regular installments. Loans can be either short-term or long-term and are typically used for purposes such as buying a home, funding education, expanding a business, or purchasing an equipment. Banks assess the borrower's creditworthiness before sanctioning the loan, often requiring collateral or security to mitigate risk. This facility helps borrowers meet large financial needs that they cannot fulfill from their own resources. For banks, loan facilities are a primary source of income through interest charges and play a vital role in driving economic growth by enabling investment and consumption. And the next is bill discounting. Bill discounting is a financial service provided by banks where they help businesses get immediate funds by purchasing their trade bills, which is also known as bills of exchange, before the due date at a discount. When a seller sells goods on credit, they draw a bill of exchange on the buyer, which is payable after a certain period. Instead of waiting for the payment, the seller can approach the bank to discount the bill, meaning the bank pays the seller the bill amount after deducting a small fee, which is known as discount. On the due date, the bank collects the full amount from the buyer. This function helps businesses maintain cash flow and working capital without waiting for credit periods to end. For the bank, bill discounting is a low-risk, short-term lending activity that generates interest income and supports trade and commerce. Now let's discuss about secondary functions that are performed by bank. Secondary functions of a bank are important because they enhance the overall usefulness and efficiency of banking services beyond just accepting deposits and granting loans. They help banks build stronger customer relationships, generate additional income through service charges or commission, and support the smooth functioning of trade and commerce. Overall, they transform a bank from being just a money lender into a comprehensive financial service provider, increasing trust, convenience, and loyalty among customers. The first type of secondary function are agency functions. Agency functions are a type of secondary function performed by banks where the bank acts as an agent on behalf of its customers to carry out various financial transactions. These functions help customers manage their money, payments, and investments conveniently and efficiently. The first is transfer of funds. It is an important secondary function of a bank where it helps customers move money from one account to another, either within the same bank or to a different bank locally or internationally. This function ensures quick, safe and convenient movement of money, reducing the need for physical cash handling. Banks use various methods like checks, demand drafts, NEFT, RTGS, IMPS, and UPI to carry out fund transfers. For example, a customer can send money to a supplier in another city using NEFT or RTGS without traveling or using cash. This service supports individuals, businesses, and institutions by enabling smooth financial transactions and promoting the growth of a cashless economy. For banks, fund transfers are a way to facilitate trade, improve customer convenience, and earn service charges, all while strengthening trust in the banking system. The next is periodic payments. The periodic payment function of a bank refers to the service where the bank makes regular payments on behalf of its customers as per their instructions. This includes payments such as loan EMIs, insurance premiums, utility bills, rent, subscriptions, or any recurring charges. Customers can give standing instructions to the bank, which ensures timely payments without requiring manual intervention each time. This function is especially useful for busy individuals and businesses as it helps them avoid missed due dates, late fees, and service disruptions. For banks, offering periodic payment services enhances customer convenience and trust while generating service income and strengthening long-term relationships. It also promotes efficient cash flow management for customers. The next is collection of checks. The collection of check is a key agency function of a bank where the bank acts on behalf of its customers to collect the amount mentioned in a check from the check issuer's bank and deposit it into the customer's account. This service allows account holders to receive payments without handling cash or visiting the payer's bank. When a customer deposits a check, the bank processes it through the clearing system and ensures that the funds are transferred from the drawer's bank to the payee's account. This function is essential for both individuals and businesses as it facilitates safe, convenient, and efficient receipt of payments. Banks may collect local, outstation, or foreign checks and often charge a small fee for the service. It supports smooth financial transactions and reduces the risk associated with cash handling. And the last is portfolio management. The portfolio management function of a bank involves providing professional guidance and services to customers in managing their investment portfolios, which may include stocks, bonds, mutual funds, and other financial instruments. Under this service, the bank helps clients make informed decisions based on their financial goals, risk appetite, and market conditions. Portfolio management may be discretionary, where the banks make decisions on behalf of the client, or non-discretionary, where the bank only advises and the client makes the final call. This function is mainly offered by banks to high net worth individuals, businesses, or institutional clients, and it helps them maximize returns while managing risks. By offering this service, banks earn fee or commission and build stronger long-term relationships with their clients while contributing to the development of a more organized and efficient investment environment. The next are utility functions. Utility functions are a category of secondary functions performed by banks that provide customers with additional convenience and value-added services beyond basic banking. These functions are designed to make banking more user-friendly, efficient, and accessible, supporting the day-to-day financial and non-financial needs of individuals and businesses. The first one is drafts. A demand draft is a prepaid negotiable instrument issued by a bank that directs another bank branch or its own branch to pay a specified sum of money to the named recipient. It is a secure method of transferring money, especially in situations where the sender and receiver are in different locations and a check might not be suitable. Unlike checks, a demand draft cannot bounce because the amount is paid in advance by the person requesting the draft. It is commonly used for making payments for college fee, government services, or business transactions. Banks charge a small fee for issuing a DD and ensuring that the payment is made to the correct person, making it a safe and reliable mode of payment for both individuals and institutions. The locker facility is a utility function provided by banks that allow customers to safely store their valuables such as jewelry, important documents, property papers, and other precious items in a secure locker within the bank's premises. These lockers are available in different sizes and are rented out to customers for an annual fee. Each locker can be accessed only with dual keys, one held by the customer and the other by the bank, ensuring maximum security. This service is especially valuable for individuals who do not feel safe keeping expensive or sensitive items at home. By offering locker facilities, banks enhance customer trust and convenience and also earn additional non-interest income, making it a beneficial service for both the bank and its customers. The next is underwriting. The underwriting function of a bank involves the bank guaranteeing the purchase of securities such as shares, bonds issued by a company or government, thereby assuring the issuer that the entire issue will be subscribed. In this process, the bank commits to buying any unsold portion of the securities during a public issue or private placement. Underwriting helps businesses raise capital more confidently by reducing the risk of an unsuccessful issue. For banks, underwriting is a way to earn fees and commission while also strengthening their relationship with corporate clients. This function plays a crucial role in capital markets by ensuring smooth fundraising and enhancing investor confidence. And the next is project reports. The project report function of a bank involves preparing a detailed and comprehensive document that outlines the feasibility, financial requirements, and expected outcomes of a business project or investment. When customers, especially entrepreneurs or businesses, apply for loans or financial assistance, banks require a project report to assess the viability and risks associated with the project. The report typically includes information about the project's objectives, market analysis, technical and financial aspects, cost estimates, expected revenues, and repayment capacity. This helps the bank make informed decisions regarding loan approval, amount sanctioned, and terms of lending. By thoroughly evaluating project reports, banks minimize the risk of default and ensures that funds are allocated to viable and profitable ventures supporting economic growth and responsible lending. Now let's talk about the Central Bank of India, which is Reserve Bank of India. The Reserve Bank of India (RBI) acts as the head of all banking institutions in India, meaning it is the supreme authority that regulates, controls, and supervises the entire banking system in the country. As the central bank, the RBI lays down the rules and guidelines that all banks, whether public, private, cooperative, or foreign, must follow. It also helps maintain public confidence in the banking system by promoting transparency, stability, and sound financial practices. Through its regulatory role, the RBI ensures that banks operate in a safe, efficient, and orderly manner, contributing to overall economic stability and growth. The Reserve Bank of India has the sole authority to issue currency notes in India, making it the country's currency issuing authority. This function is carried out under the provisions of the RBI Act 1934 and helps ensure uniformity, security, and trust in the Indian currency system. The RBI issues all currency notes except 1 rupee notes and coins, which are issued by the Government of India but distributed by the RBI. It follows the minimum reserve system, maintaining a minimum reserve of rupees 200 crores, 115 crore in gold and the rest in foreign securities to back the currency in circulation. The RBI ensures that the right amount of currency is supplied across the country based on demand, economic activity and inflation. It also withdraws damaged or counterfeit notes and replaces them with new ones to maintain currency quality. This function is crucial in maintaining monetary stability, controlling inflation, and ensuring public confidence in the currency. The RBI acts as the financial advisor, banker, and debt manager for both the central and state governments. It manages their accounts, receives and makes payments on their behalf, and facilitates the issue of government securities like treasury bills and bonds. Additionally, the RBI advises the government on monetary and fiscal policy matters, helping maintain economic stability. The RBI is the banker's bank, meaning it holds reserves of commercial banks, provides them with funds in times of need, and acts as a clearinghouse for settling interbank transactions. It controls the credit operation of banks through tools like the cash reserve ratio and statutory liquidity ratio. In times of liquidity shortage, banks can borrow from the RBI using the repo rate. The RBI also supervises and regulates the functioning of banks to ensure a sound and stable banking system. The RBI plays a key regulatory role by overseeing the granting and renewal of licenses to banks and other financial institutions in India. Under the Banking Regulation Act 1949, no bank can start or continue banking operations without obtaining a license from the RBI. Before a new bank can begin operations, it must apply to the RBI, providing details about its capital structure, promoters, business plan, management background, and proposed area of operations. The RBI thoroughly examines the application to ensure that the bank has financial strength, a sound business model, and the ability to operate responsibly. Only if all conditions are met does the RBI grant a banking license. In the case of cooperative banks and some other financial institutions, licenses are renewed periodically. The RBI assesses their financial health, governance, risk management, and compliance with regulatory norms before renewing the license. If any bank fails to meet the required standards, the RBI can refuse renewal, impose conditions, or even cancel the license. Through regular inspections, audits, and supervision, the RBI assesses a bank's financial health, risk management systems, asset quality, capital adequacy, internal controls, and overall functioning. These inspections can be scheduled or surprise checks, and they help detect problems like fraud, mismanagement, or non-compliance with regulations at an early stage. If any irregularities are found, the RBI may issue warnings, impose penalties, or direct corrective action. In addition to banks, the RBI also monitors non-banking financial companies and cooperative banks. By conducting inquiries and inspections, the RBI ensures that financial institutions operate transparently, fairly, and in the best interest of depositors and the economy. This function is crucial for maintaining public confidence, financial discipline, and overall economic stability in the country. Now let's talk about different types of banks that function in the Indian economy. The first are public sector banks. Public sector banks in India are banks in which the majority stake, which is more than 50%, is held by the Government of India. These banks are owned and operated either fully or partially by the central government, and they play a crucial role in implementing the government's financial and economic policies. PSBs aim to provide banking services to all sections of society, including underserved, rural, and semi-urban areas, thereby promoting financial inclusion and economic development. Public sector banks offer a wide range of services such as accepting deposits, granting loans, issuing debit or credit cards, and providing online and mobile banking. They are regulated by the RBI and are also supervised by the Ministry of Finance. Some of the major PSBs in India include State Bank of India, Punjab National Bank, Bank of Baroda, and Canara Bank. These banks are trusted by the public due to government backing, and they also participate in national development programs like priority sector lending, government subsidy schemes, and financial literacy campaigns. Public sector banks form the backbone of India's formal financial system, contributing significantly to the country's banking outreach and economic stability. The next is private sector banks. Private sector banks in India are banks where the majority ownership and control lie with private individuals or corporate entities rather than the government. Unlike public sector banks, these banks are driven by profit motives and operate with greater autonomy in decision making and management. They offer a wide range of banking products and services, including savings and current accounts, loans, credit cards, wealth management, and digital banking solutions, often focusing on customer centric innovation and technology. Private sector banks are regulated by the Reserve Bank of India and follow all banking laws, but they tend to be more agile and competitive, frequently introducing new financial products and better customer service. Some of the prominent private sector banks in India include HDFC Bank, ICICI Bank, Axis Bank, Kotak Mahindra Bank, and IndusInd Bank. These banks play a vital role in complementing public sector banks by catering to urban and semi-urban customers, driving financial inclusion through modern banking technology, and supporting industries and businesses with flexible credit options. Their efficiency, customer focus, and innovation have significantly transformed the Indian banking landscape over the last few decades. The next is cooperative banks. Cooperative banks in India are financial institutions that operate on a cooperative basis, meaning they are owned and managed by their members who are also the customers. These banks primarily aim to serve the financial needs of their members, often focusing on agriculture, small scale industries, and rural communities. Cooperative banks play a crucial role in promoting financial inclusion by providing affordable credit and banking services to people who may not have easy access to commercial banks. Cooperative banks in India are broadly classified into two types. The first is urban cooperative banks and the second is rural cooperative banks. Talking about urban cooperative banks, they operate mainly in urban and semi-urban areas, and they serve individuals and small businesses with services like deposits, loans, and advances. On the other hand, rural cooperative banks include state cooperative banks and district central cooperative banks, focusing on agricultural credit and rural development. These banks are regulated by both the RBI for banking operations and the Registrar of Cooperative Societies for cooperative management. Examples of cooperative banks include Saraswat Bank, Cosmos Bank, and various state cooperative banks. By mobilizing savings and providing credit at reasonable rates, cooperative banks support local economic growth, encourage self-reliance, and uplift rural and underserved populations in India. The next is development banks. Development banks in India are specialized financial institutions established to provide long-term capital and financial assistance for the promotion and growth of industries, agriculture, infrastructure, and other key sectors of the economy. Unlike commercial banks, which primarily focuses on short-term credit and everyday banking services, development banks focus on financing projects that contribute to economic development and help build the country's productive capacity. These banks offer loans, equity participation, underwriting of shares, and advisory services to businesses, especially those in priority sectors such as small scale industries, export promotion, and rural development. They play a crucial role in filling the gap where private capital is insufficient or hesitant to invest due to long gestation periods or higher risks. Examples of important development banks in India include Industrial Development Bank of India, Small Industries Development Bank of India, National Bank for Agriculture and Rural Development, Export-Import Bank of India, Housing Development Finance Corporation. Development banks contribute significantly to India's industrialization, infrastructure expansion, and rural upliftment by providing the necessary financial backbone to long-term projects that drive sustainable economic growth. The next is foreign banks. Foreign banks in India are banks that are headquartered outside India but operate branches or subsidiaries within the country. These banks bring international banking expertise, advanced technology, and global financial services to the Indian market. They primarily serve multinational corporations, foreign investors, and high net worth individuals, although many have expanded their services to retail customers as well. Foreign banks in India offer a wide range of banking products such as corporate banking, trade finance, forex services, wealth management, and investment banking. Because of their global presence, they facilitate international trade and capital flows, helping Indian businesses connect with global markets. These banks operate under the regulation and supervision of the RBI and must comply with Indian banking laws and guidelines, just like domestic banks. Some well-known foreign banks operating in India include Citibank, HSBC Bank, and Standard Chartered Bank. Foreign banks contribute to increasing competition in the Indian banking sector, encourage the adoption of international best practices, and provide customers with diversified and sophisticated financial products. Now let's discuss about different banking instruments. Banking instruments are financial tools used by banks and customers to conduct, facilitate, or secure financial transactions. The first is check. A check is a written, dated, and signed instrument that directs a bank to pay a specific sum of money from the drawer's account to the person named or to the bearer of the check. It serves as a convenient and secure method of payment in both personal and business transactions. Checks can be of various types, like bearer check, which are payable to whoever presents them. The other is order checks, which are payable to a specific person, and crossed checks, which can only be deposited into a bank account, not encashed directly. To be valid, a check must contain essential details such as the amount, date, signature of the drawer, and name of the payee. Once presented, the bank verifies the details and processes the payment, provided there are sufficient funds in the account. Checks are governed in India by the Negotiable Instruments Act 1881. The other one is draft. A bank draft, also known as a demand draft, is a prepaid financial instrument issued by a bank on behalf of a customer, directing another bank or branch to pay a specified sum to the person named in the draft. Unlike a check, the payment through a bank draft is guaranteed because the amount is paid in advance by the purchaser and the bank itself undertakes the responsibility of payment. This makes it a safer option for large transactions, especially when the payee requires assured payment, commonly used in situations like college admissions, tender submissions, or real estate deals. Bank drafts cannot be dishonored due to insufficient funds, as the amount is already with the bank at the time of issuance. They are governed under the Negotiable Instruments Act 1881 and usually cannot be endorsed to another person. The next is Bill of Exchange. A bill of exchange is a written, legally binding financial instrument that orders one party to pay a fixed sum of money to another party, either on demand or at a specified future date. It is commonly used in trade transactions, especially in international commerce, to ensure payment between buyers and sellers. The bill is drawn by the creditor and must be accepted by the drawee, indicating their agreement to pay. Once accepted, it becomes a legal obligation. Bills of exchange help sellers receive payment on credit while giving buyers time to arrange funds. They can also be endorsed and transferred to others. These instruments are governed by the Negotiable Instruments Act 1881 in India and provide security and clarity in credit-based transactions. The next is deposit slip. A deposit slip is a written form provided by a bank that allows a customer to deposit cash or checks into their bank account. It typically includes details such as the depositor's name, account number, date, type of deposit, the amount being deposited, and a breakdown of the denominations if cash is involved. The depositor fills out the slip and submits it along with the money or checks at the bank's counter. Once processed, the bank returns a stamped acknowledgement portion of the slip as proof of the transaction. This is known as a counterfoil. Deposit slips ensure accuracy in deposits and serve as a formal record for both the bank and the customer. The next is withdrawal slip. A withdrawal slip is a printed form used by bank account holders to withdraw money from their savings or current accounts. It typically requires the customer to fill in details such as the account holder's name, account number, date, amount to be withdrawn, and the depositor's signature. The slip is submitted at the bank's counter, often along with an identity proof, especially if the customer is not using a check. Once verified, the bank officially disperses the specified amount in cash. Withdrawal slips are commonly used in bank branches that offer manual cash withdrawal facilities and provide a secure, recorded method of accessing funds without using a check or ATM. The next is credit card. A credit card is a payment card issued by banks or financial institutions that allow users to borrow funds up to a predetermined credit limit to make purchases or withdraw cash. Unlike a debit card, the money spent using a credit card is not immediately deducted from the user's bank account. Instead, the card holder borrows money which must be repaid later, either in full or through monthly installments with interest. Credit cards offer convenience, safety, and additional benefits such as rewards, cashback, and fraud protection. They help build credit history but require responsible use to avoid debt accumulation and high interest charges. Credit cards are widely accepted worldwide for both in-store and online transactions. The next is a debit card. A debit card is a plastic payment card linked directly to a customer's bank account, allowing them to make purchases or withdraw cash up to the available balance in their account. When a debit card is used at a point of sale terminal or ATM, the payment amount is immediately deducted from the linked account, ensuring that users can only spend money they have. Debit cards are widely accepted for everyday transactions, both in physical stores and online, and often come with features like PIN, chip technology, and contactless payments for convenience and safety. Unlike credit cards, debit cards do not allow borrowing. They help users manage their finances by limiting spending to their actual bank balance. The next is a bank statement. A bank statement is a detailed document issued by a bank to its account holder summarizing all the transactions that have occurred in their account over a specific period, usually a month. It includes information such as deposits, withdrawals, check clearances, electronic transfers, fees charged, and the opening and closing balances. Bank statements help customers track their financial activity, verify transactions, detect any unauthorized activity, and manage their budgets. They are also essential for various official purposes like loan applications, tax filings, and financial audits, serving as proof of income or account activity. Many banks now provide electronic bank statements for easy and secure access. And the next is Forex card. A Forex card is a prepaid travel card loaded with foreign currency designed to help travelers make payments and withdraw cash abroad conveniently and securely. It functions like a debit or credit card but is specifically meant for international use, allowing users to avoid currency exchange hassles and fluctuating rates during their trip. Forex cards can be loaded with multiple currencies and are accepted at ATMs, shops, hotels, and restaurants worldwide that accept card payments. They offer benefits such as better exchange rates, protection against theft or loss, and easy reload options. Using a Forex card is often safer and more cost effective than carrying large amounts of foreign cash while traveling. The next is digital banking. Digital banking refers to the delivery of banking services through electronic and online platforms, allowing customers to perform financial transactions anytime and anywhere using devices like smartphones, computers, or tablets. It eliminates the need to visit a physical branch for activities such as money transfers, bill payments, account management, loan applications, and investment tracking. Digital banking leverages technologies like mobile apps, internet banking, and automated services to provide convenience, speed, and enhanced user experience. It also includes features like instant notifications, biometric security, and AI-powered chatbots for customer support. Digital banking has transformed the traditional banking landscape by making financial services more accessible, efficient, and customer-friendly. Here are the different modes of digital banking commonly used today. So let's learn about them. The first is internet banking. It is also known as online banking or net banking. It allows customers to access and manage their bank accounts securely over the internet through a bank's official website. Using internet banking, customers can perform a wide range of financial activities such as checking account balances, transferring funds between accounts, paying bills, applying for loans, and downloading account statements. This is all without visiting a physical branch. It offers convenience and 24/7 availability, which includes quick transaction processing, which is making banking easier and more efficient. To ensure security, banks use measures like two-factor authentication, encryption, and secure login credentials. Internet banking has become a fundamental part of modern banking, empowering users to handle their finances anytime and anywhere. The next is mobile banking. It is a digital banking service that enables customers to perform financial transactions and manage their bank accounts using a smartphone or tablet through a dedicated mobile app or mobile optimized website. It offers convenient access to a wide range of services such as checking account balances, transferring funds, paying bills, recharging mobile phones, applying for loans, and even investing, all from the palm of your hand. Mobile banking apps often include advanced security features like biometric authentication and real-time alerts to protect user information and prevent fraud. This mode of banking has revolutionized the way people interact with their banks by providing fast, easy, and secure access to banking anytime and anywhere. The next is UPI, which is Unified Payments Interface. It is a real-time digital payment system developed in India that enables instant money transfers between bank accounts using a mobile device. It simplifies payments by allowing users to send or receive money using just a virtual payment address, mobile number, or QR code without needing bank account details. UPI is accessible through multiple banking apps and third-party apps like Google Pay, PhonePe, and Paytm, making it widely popular for peer-to-peer transfers, bill payments, and merchant transactions. It operates 24/7, including holidays, and processes transactions within seconds. By providing a fast, secure, and convenient alternative to traditional payment methods, UPI has significantly transformed India's digital payment landscape by promoting cashless and paperless transactions. The next is digital wallet. It is also known as an e-wallet. It is a software-based system that securely stores users' payment information and passwords for numerous payment methods and websites. It allows individuals to make electronic transactions quickly and conveniently using their smartphones or computers without the need to carry physical cash or cards. Digital wallets can hold money digitally, enabling users to pay for goods and services online or in store, transfer funds, and even store loyalty cards or tickets. Popular examples include Paytm, Google Pay, and Apple Pay. These wallets use encryption and authentication technologies to ensure transaction security, making payments faster, safer, and more seamless in the growing digital economy. The next is eKYC. It is a digital process used by banks and financial institutions to verify the identity. It is a digital process used by banks and financial institutions to verify the identity and address of customers online without the need for physical document submission. It leverages government databases such as the Aadhaar system in India to authenticate a customer's details quickly and securely using biometric data like fingerprints or iris scans or OTPs sent to a registered mobile number. eKYC simplifies account opening, loan applications, and other financial services by reducing paperwork, speeding up verification, and enhancing customer convenience while maintaining regulatory compliance and preventing fraud. This technology has revolutionized onboarding in the banking sector by making it faster, safer, and more accessible. The next is digital loans. These are loans that are applied for, processed, and dispersed entirely through online platforms without the need to visit a physical bank branch. Using digital technology, borrowers can submit applications upload documents, and track approval status via websites or mobile phones. The use of automated algorithms, artificial intelligence, and data analytics enables lenders to quickly access credit worthiness and make faster lending decisions. Digital loans offer convenience, speed, and accessibility, especially for individuals and small businesses who might find traditional loan processes time consuming. These loans often have transparent terms and flexible repayment options, making credit more accessible in today's digital economy. Now let's see different career paths in banking. So career paths in banking for BCom graduates are diverse and offer excellent growth opportunities both in public and private sector banks. With a strong foundation in commerce, accounting, and finance, BCom graduates are well suited for entry-level and mid-level roles across various banking domains. Some of the profiles in banking are: the first is personal banker. A personal banker is a frontline banking professional responsible for managing the financial needs of individual customers at a bank branch. Their primary role involves helping clients open and manage bank accounts, advising on suitable financial products like savings account, fixed deposit, loans, credit cards, and investment options. They also assist with service requests such as checkbook issuance, debit card problems, and internet banking support. Personal bankers are expected to maintain strong relationship with customers, ensure high service quality, and often meet sales targets by cross-selling banking products. This role requires excellent communication skills, a good understanding of banking services, and a customer-centric approach. The next is a cashier. A cashier in a bank, also known as a bank teller, is responsible for handling day-to-day cash transactions at the bank's counter. Their primary duties include accepting deposits, processing withdrawals, cashing checks, issuing demand drafts, and managing currency exchanges. Cashiers ensure that each transaction is accurate, properly recorded, and compliant with bank policies. They also verify signatures, check for counterfeit notes, balance cash at the end of the day, and provide basic customer service. Since they directly deal with customers and large sums of money, attention to detail, honesty, and efficiency are critical qualities for a cashier in a bank. The next is a relationship officer. A relationship officer in a bank is responsible for building and maintaining strong relationships with customers to ensure their banking needs are met while also promoting the bank's financial products and services. They assist clients with opening accounts, applying for loans, investing in fixed deposits or mutual funds, and using digital banking services. Relationship officers play a key role in cross-selling products like credit cards, insurance, and wealth management services based on the customer's profile and financial goals. They often work with individual clients or small businesses and are expected to meet sales targets while delivering high-quality customer service. Strong interpersonal skills, product knowledge, and a proactive attitude are essential for success in this role. The next is a loan officer. A loan officer in a bank is responsible for evaluating and processing loan applications from individuals or businesses seeking financial assistance. Their main duties include meeting with clients to understand their credit needs, explaining different loan products, collecting necessary documents, and assessing the applicant's credit worthiness based on financial statements, income, credit history, and repayment capacity. Loan officers work closely with the credit and risk departments to ensure each loan complies with the bank's lending policies and regulatory guidelines. Once approved, they also assist in disbursing the loan and may monitor repayments. This role requires strong analytical skills, attention to detail, and excellent customer service abilities. The next is a credit analyst. A credit analyst in a bank is responsible for assessing the creditworthiness of individuals, businesses, or projects applying for loans or credit facilities. They analyze financial statements, income sources, credit reports, repayment history, and industry trends to evaluate the risk involved in lending. Based on their analysis, they prepare detailed credit appraisal reports and recommend whether a loan should be approved, modified, or declined. Credit analysts also assign credit ratings, determine appropriate loan terms, and ensure compliance with the bank's risk and regulatory guidelines. This role is critical in maintaining the quality of the bank's loan portfolio and requires strong financial acumen, analytical skills, and knowledge of credit policies and financial modeling. The last is Forex. The foreign exchange profile in a bank involves managing and facilitating international currency transactions for individuals, businesses, and institutions. Professionals in this role handle services such as currency conversion, foreign remittances, export-import payments, issuance of forex cards, and advisory on hedging strategies for exchange rate fluctuations. They ensure compliance with regulations set by the Reserve Bank of India and FEMA. They maintain accurate documentation and monitor market trends to support clients in managing currency risks. Forex officers or dealers may also engage in interbank trading or help corporate clients with forward contracts and other risk mitigation tools. This role requires knowledge of international finance, attention to detail, regulatory compliance, and proficiency with treasury or trading systems. The next topic which we are going to discuss in detail is about foreign exchange. Banks handle a wide range of foreign exchange transactions to meet the international currency needs of individuals, businesses, and institutions. These include currency exchange for travelers and companies, issuing foreign currency demand drafts for overseas payments, and facilitating inward and outward remittances through networks like SWIFT. Banks also process export and import payments using instruments such as letter of credit and bills of exchange. Additionally, they provide forex cards for convenient access to foreign currency abroad and offer forward contracts to help clients hedge against exchange rate fluctuations. For corporate clients, banks may offer advanced derivative products like currency swaps and options to manage forex risks. Behind the scenes, banks manage correspondent banking accounts to ensure smooth cross-border transactions. All these operations are carried out under strict compliance with regulatory guidelines set by the Reserve Bank of India and the Foreign Exchange Management Act. Banks facilitate the purchase of foreign currency through several streamlined processes designed to meet the needs of individuals and businesses. Customers can buy foreign currency cash, travel cards loaded with foreign currency, or make foreign currency demand drafts for overseas payments. Banks require customers to provide necessary identification and documentation such as a valid passport, visa, and purpose of travel or transaction to comply with regulatory guidelines like FEMA and RBI rules. The bank then quotes the prevailing exchange rate and processes the transaction either at the branch, through internet banking, or via specialized forex counters. For larger corporate transactions, banks also arrange forward contracts or hedging solutions to protect against currency fluctuations. Throughout the process, banks ensure adherence to legal limits on currency purchase and maintain records for regulatory reporting. This enables customers to obtain foreign currency securely, conveniently, and in compliance with all legal requirements. Now let's discuss about a forex card in detail. A forex card is a prepaid, reloadable card issued by banks or authorized financial institutions that allows travelers to carry multiple foreign currencies conveniently and securely while traveling abroad. It functions like a debit or credit card but is preloaded with a fixed amount of foreign currency, protecting users from currency rate fluctuations. Forex cards are widely accepted at ATMs, shops, restaurants, and online merchants globally, providing easy access to funds without the need to carry cash. They offer benefits like competitive exchange rates, lower transaction fees compared to cash or credit cards, and enhanced security features such as PIN protection and the ability to block the card if lost or stolen. Additionally, many forex cards allow users to load multiple currencies on a single card, making them a convenient and cost-effective options for international travel. Let's discuss about different features of a forex card. Now let's talk about different features of a forex card. The first is multiple currencies. Forex card can be loaded with one or more foreign currencies such as US dollars, euros, Great Britain pound, Japanese yen, etc. before your trip. This multi-currency feature means you can travel to different countries without worrying about exchanging currency each time. It helps avoid repeated forex conversion charges, making transactions smoother and cheaper. The next is security. Forex card come with advanced security features like EMV chip technology and PIN protection, which makes them safer than carrying cash. If the card is lost or stolen during travel, it can be blocked immediately by contacting the issuing bank's helpline, protecting you from unauthorized transactions. The next is global acceptance. These cards are accepted worldwide at millions of ATMs, point of sale terminals in stores, restaurants, hotels, and online merchants that accept Visa, MasterCard, or other international card networks. This wide acceptance ensures you have easy access to money wherever you go. The next is reloadable. You can reload your forex card online or at your bank branch with additional funds. If your travel gets extended or you need extra money, reloading helps avoid the inconvenience of carrying excess cash or apply for a new card. The next is competitive exchange rates. Forex cards generally offer better exchange rates compared to exchanging cash at currency counters or using credit or debit cards for foreign transactions. This is because the exchange rate is fixed at the time of loading the card, protecting you from currency rate fluctuations later on. The next is cost effectiveness. Forex cards come with minimal or no markup fee on currency conversion. Unlike credit cards, they usually don't attract high foreign transaction fees or interest charges. This makes them a more economical option for managing foreign currency expenses during travel. Now let's see how banks process international transactions. The first is foreign exchange conversions. Foreign exchange conversion is a crucial step in processing international transactions because it involves converting the amount from one currency to another to complete the payment. When a customer initiates an international transaction, the sending bank first determines whether currency conversion is needed based on the currencies involved in the transfer. If required, the bank converts the amount at the prevailing exchange rate or a pre-agreed forward contract rate. This conversion ensures that the beneficiary receives the correct amount in their local currency. The bank's treasury or forex desk handles this conversion using live market rates or negotiated rates to execute the transaction efficiently. Accurate forex conversion is vital to reflect the correct value, avoid losses due to currency fluctuations, and comply with regulatory guidelines. It also influences the fees charged and the final amount credited to the beneficiary's account, making it a key step in the seamless processing of international payments. Next is message transmission. Message transmission is a vital step in processing international transactions where banks communicate payment instructions securely and accurately across borders. Once the transaction details, including amount, currency, beneficiary information, and purpose, are finalized, the sending bank transmits these instructions to the beneficiary's bank using standardized messaging networks, most commonly the SWIFT system. SWIFT stands for Society for Worldwide Interbank Financial Telecommunication. SWIFT provides a secure, fast, and reliable platform for exchanging financial messages between banks worldwide. This message contains all necessary information to authorize and execute the transfer. Proper and error-free message transmission ensures that funds reach the correct recipient without delays or misrouting. It also enables tracking and confirmation of the transaction status by both banks, making it a critical step for transparency, accuracy, and compliance in international fund transfers. The next is correspondent bank involvement. Correspondent bank involvement is a key step in processing international transactions, especially when the sending and receiving banks do not have a direct relationship or operate in different countries. Correspondent banks act as intermediaries that facilitate the transfer of funds across borders by maintaining nostro and vostro accounts, which they hold for each other. When a customer initiates an international payment, if the sender's bank cannot directly transfer funds to the beneficiary's bank, it routes the payment through one or more correspondent banks. These banks help bridge the gap between the two institutions by receiving, converting, and forwarding the funds until they reach the beneficiary's bank. Correspondent banks also handle currency settlement and ensure compliance with regulatory requirements during the transaction. Their involvement is crucial to enable smooth, secure, and timely international payments, especially in cases where direct banking links are unavailable. The next is funds transfer. It is a critical step in processing an international transactions where the actual movement of money takes place from the sender's bank account to the beneficiary's account. After all the preparatory steps such as documentation, currency conversion, message transmission, and routing through correspondent banks are completed, the sending bank debits the customer's account for the specified amount. The funds are then transferred through the banking network, which may involve one or more intermediary correspondent banks until they reach the beneficiary's bank. The beneficiary's bank, upon receiving the funds, credits the recipient's account in the designated currency. This step completes the financial aspect of the transaction and is typically accompanied by confirmation messages sent between banks to ensure the transfer's success. The efficiency and accuracy of funds transfer are vital to maintaining trust and reliability in international banking operations. The next is fee and charges. Fees and charges are an important step in processing international transactions as banks apply various service costs associated with handling cross-border payment. These fees may include transfer fees, currency conversion charges, correspondent bank fees, and sometimes intermediary or receiving bank charges. When a customer initiates an international transaction, the sending bank informs them about applicable fees upfront or deducts them from the transaction amount. Correspondent banks involved in routing the funds may also deduct their fees during the transfer process. Additionally, currency conversion may attract a markup on the exchange rate, which effectively acts as a cost. All these charges are carefully accounted for to ensure transparency, and they directly affect the final amount received by the beneficiary. Proper disclosure and management of fees and charges are essential to maintain customer trust and comply with banking regulations. Next is compliance and regulation. It ensures that all transfers adhere to legal and regulatory frameworks set by authorities like the Reserve Bank of India, Foreign Exchange Management Act, anti-money laundering laws, and international standards. Before processing the transaction, banks verify the customer's identity, validate the purpose of the payment, and screen the parties involved against sanction lists to prevent illegal activities such as money laundering, terrorist financing, or fraud. Banks must also ensure that the transaction complies with limits on foreign exchange, reporting requirements, and documentation standards. This step protects the banking system's integrity, ensures transparency, and reduces the risk of financial crime, making compliance a mandatory and ongoing part of every international transaction. And the next is settlement and reconciliation. Settlement and reconciliation is the final step in processing an international transaction. Settlement refers to the actual completion of the payment where the sending bank transfers funds to the receiving bank and the beneficiary's account is credited with the correct amount in the specified currency. This involves updating the respective nostro and vostro accounts held by correspondent banks to reflect the transfer of funds. Once the funds have been settled, reconciliation ensures that the transaction records on both the sending and receiving sides match perfectly, verifying that the amount sent equals the amount received and all fees and charges have been accounted for accurately. Reconciliation helps identify and resolve any discrepancies or errors that may have occurred during the process. Together, settlement and reconciliation guarantee the accuracy, transparency, and successful completion of international transactions, thereby maintaining trust in the banking system. So that's all about banking sector in India. We will meet again in another video lecture with a new topic for upskilling commerce. Thank you.